So, in business, in sport, and with your portfolio, you should never be too high or never be too low. Today, we're talking about the perfectly balanced portfolio. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. Welcome to this quite interesting series that we started a few days ago on how to invest in 2025. I am with my co-host, of course, Véronique, and today is Happy New Year. That's kind of crazy. So yeah, we are entering the first day of January 1st. Véro, Happy New Year.
Thank
I'm
you.
gonna wish I'm gonna wish for you that you get your horse, because I think that's gonna be the most important thing above
Yes.
health and wealth. You just want to have a good horse. That's going to be amazing. So I hope that you will enjoy 2025, but most importantly, that you realize one of your biggest dream this year.
Well, like you've said, you already know that I'll be shopping for a horse by the end of 2025. So I'm very excited about that. I've been working more hours since fall of 2024 to like put some money aside. So I mean, plan is going well. We also plan to visit friends with the kids, so it should be fun. And on a professional level, you've mentioned that at the beginning of the series, but like we're launching a retirement loop, a retirement community. I just can't wait to see how it will evolve. So I mean, yeah, 2025 should be very interesting and a good year overall. So happy new year to you as well, Mike. And what can we wish you for 2025?
Well, I already have a pretty good lineup for this year, so I just wish that everything goes to plan, which never happens. But anyways, that's pretty much the goal. Huge year on the professional side for the business. Dividend Stocks Rock keeps on growing. Now we have Retirement Loop. You're going to hear about it a little bit more in the next few days, but doors are closing on January 6th. So hurry up, because I don't know when I'm going to open them again. So the idea is to build a community of people about to retire or retired already. So to provide them with the tools to make those retirement plans, and once they are retired, well, to make sure that they hold their ship steady and they continue to just enjoy retirement. So that's one of the reasons why we're closing doors, is to make sure that we can take care of the first cohort the right
Mhm.
way, and that we will build this new community based on what their needs are and what you're looking for and your feedback. So just take a moment, send us an email if you're to just to make sure that you are on the newsletter list, so you receive that invitation.
And today we will discuss two ways to achieve a perfectly balanced portfolio. The first one involves, of course, sector allocation. So there are 11 sectors. Which ones should investors pick?
So I love that question, because my answer, it depends, and we can hand the show on that. More seriously, but that's the thing. So there are 11 sectors, and there are sectors for a little bit more growth, there are sectors for a little bit more of income, but most importantly, there are great opportunities in each sector. It doesn't mean that you have to seize them all either. So rather than going for all sectors, or for going for the next sector that's going to be the next big thing, I suggest that you only invest in sectors that you understand how they work. And by
Mhm.
how they work, I mean, what's their growth opportunities, what's their risk potentials, how they will be impact with market event, with economic events. So here's an example. I do have a strong background in the financial sector, because I worked as a private banker and I work in a bank for more than 13 years. I also have a strong technology background because I've been evolving around this since 2006, building blogs, doing webinars, having a membership website. So I am highly interested and I have like good knowledge of those two sectors. Well, if you look at my portfolio, no surprise here, my two largest sectors are financials and information technology. I understand them. I feel comfortable with them, and most importantly, I understand the risk. So for technology, for example, you will have the risk of like the innovation cycle. So a company must always innovate. If not, it's going to be not relevant very quickly and could fail. So knowing how to analyze those companies are super important. I once had a client that worked for Johnson & Johnson for like 25 years. Of course, his largest sector was healthcare, but it was because he understood how patents work, how healthcare company works a lot more. And of course, he had a higher level of confidence in this type of sector. And that's the most important part, is to have that high level of confidence, because when things go bad, well, you will know why you have those companies, why you invest in that sector, and you will understand how that sector will be able to get out of troubles and recover. Because if you have no clue how a utility company works and you don't know the difference between a regulated utility and a non regulated utility, well, then you're going to panic when you see a stock going down by 25%, and yet you will have no clue what to do, what to look for, and how to monitor this company so it has chances of recovering or not. So that's why it's important to just select sectors that you really understand.
And Mike, what do you think is the ideal percentage to have in each sector and why?
Well, I'd say anything between 5 and 20%. Most of the time, because like 5% will involve that you have selected one or two company in a sector, get kind of like the best companies of each industries. And I try not to go above 20% in a specific sector, mostly because I don't want to be highly exposed to one single risk. As I already mentioned before on the show, if there is a market crisis, it will affect a specific sector. So if you have like 40% of your money invested in that sector, your portfolio is going to have a hard time to recover. But if you're well diversified with like 10, 15, 20% on a lot of them, then it's going to be a lot easier for you to recover. And chances are you're going to have some of great companies that are thriving during bull market as well. One other thing is important is do not go too heavy on sector rotation. So moving from one sector to another. And I do have an example for that. When Trump won the election in 2016, so the first time he won that presidency, the military sector actually went up very fast. So everybody was bullish for the Northrop Grumman, General Dynamics, Lockheed Martin, and all of those military stocks. And you could have thought, well, it's going to be it happened the same thing in November of 2024 when Trump won again for his second mandate. Well, no,
Mhm.
it was the opposite. So he made someone chief of the Pentagon. The market didn't like that, created some confusing. So long story short, most military companies drop by like 5 to 10% on that day. So trying to position your portfolio for something that you think is going to happen is closer to gambling than investing.
Also, Mike, let's not forget that sector allocation is not necessarily equally weighted because of the number of industries some sectors have, right?
That's correct. One thing I did not mention is even though I'm trying not to have more than 20% in a specific sector, sometimes you can make an exception. It's more like a guideline more than a hard rule, where if you have, for example, 30% of your portfolio invested in the industrial sector, well, maybe you have railroads, maybe you have aerospace and military defense companies, maybe you have engineering companies. They don't have much in common, so they will not be impacted by the same market event. So therefore, you're still well diversified if you invest in several different industries, but they are still part of the same sector. On the other side, like a sector like utilities could be a lot harder to diversify because then you pretty much have the difference between regulated to non-regulated, classic power utilities, water utilities, and that's pretty much the end of it. So it's going to be very hard to diversify your portfolio across several subsectors in the utility one versus the industrial sector.
Now, the second way to achieve a perfectly balanced portfolio is to assess the risk you take with each holding. To do that, we use three stock categories: core holdings, educated guesses, and falling knives. What does each one mean, Mike?
So this is kind of like a homemade type of way to categorize your
Mhm.
stocks. You could have like more or less. The point is about the perception you have for each company in your portfolio or the role you want to give to those companies. I like to keep things simple, so we went for three categories. So the core holdings are really companies that would be defined like Warren Buffett style. You know, you can buy one, you can put it in a black box, forget about it for 10, 15 years, and you would feel good. Like the core holding companies tick all the boxes of your investment strategy, depending on what your investment strategy is. Educated guesses, they are like great companies ticking most of the boxes of your strategy, but there are some like risk, some uncertainties that you're not too sure. So they're almost perfect, but they are not perfect, and that's why they fall into the educated guesses. And then you have the falling knives or the speculative plays. So this is really like when you have play money, you want to take a bet on something. So of course, those come with high risk, but also high rewards. So this is the type of investment that if you put $10,000 in it, you either expect it's going to double to $20,000 or you would be fine to lose and then go back to $2,000.
And what percentage should core holdings, educated guesses, and falling knives represent in our portfolio?
So in general, for my portfolio, I like to have some play money. So I usually have between 5 to 10% of speculative plays, depending on the moment of the market. So right now we're at all-time high. There's not that many opportunities, so I'm closer to 4 or 5% than 10. But again, it's just like to have like some fun. Most of the time, what I want is to have like 90% of my portfolio invested in my core strategy, which revolves around companies increasing their dividend year after year. So, in an ideal world, most of your portfolio should be towards core holdings, and then you can have like a small percentage into educated guesses, another small percentage into falling knives or speculative plays. So, altogether, the guesses and the knives should be maybe like 20, 25%, not more than that. And ironically, I've looked back into my performance a few times, and the core holdings are actually the one that are showing the best, like best longevity, of course, but the best total return as well. So one more win for the core holdings in terms of keeping your winners for a very long run whenever you have the chance of selecting one.
And again, Mike, do investors need to have all three categories?
I don't think so. I mean, especially if you have like a lower risk tolerance or as you age and you get into closer to retirement or if you're retired, do you really need to have play money? Do you really need to take guesses? Maybe it's just time for you to be more selective and have fewer companies in your portfolio with stronger financial metrics. Uh, I'm tempted to tell you that as I age, I will probably go even more towards micro holdings than anything else. Even though it's fun and exciting to have like those good stories, especially like during the holidays, right, where you can say, "Hey, I've invested in this company; it was amazing." But you know what? We always hear about the great trades, and we tend to forget all the others. So in the end, I'm not too sure it's really worth it when you look at your global total return.
In summary, Mike, what's the best way to achieve a perfectly balanced portfolio and why is it important to do so in 2025?
So each year I use Dividend Stocks Rock Pro dashboard to do my review. So I start with a global view. So it's important to look at the big lines first. So I look at my asset allocation, my sector allocation, the exposure to Canadian stocks versus US, and then I go towards the stock. So to have a perfectly balanced portfolio, you must look at your diversification, but at each level. So you start with the big lines. Am I aligned with my strategy? Is there any outliers there that I should not have invested in? Am I well invested in many sectors, many countries, and is my asset allocation is great? So do I have like all my money into the stock market and then I'm like freaking out every time the market goes down by 5%? Maybe I should think of like adding some fixed income or something like that.
Mhm.
So it's really important to not modify your portfolio according to what's happening with the market, but rather being able to stick with the same strategy no matter where the market goes.
Well, thank you, Mike, for helping us reach our perfect balance. Listeners, make sure to download the Top Stocks booklet now at thedividendguyblog.com/topstocks. And also visit our show notes at thedividendguyblog.com/208. Tomorrow, we will give you access to a stock checklist, so subscribe to the show now so as not to miss it. And until then, stay
Stay
invested.
invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.